Hello and welcome to SmartKarma's corporate webinar. I am Vidhi Bhatt from the corporate solutions team at SmartKarma. This week, we are very happy to have with us Elite Commercial's management team with us. We have Shaldine Wang, the CEO. We have Jonathan Edmunds, the CIO. He'll be joining in soon. We have Cheah, the CFO. We will start this webinar with Shaldine walking us through a corporate presentation about the company, after which the team will engage in a fireside chat with SmartKarma analyst Sumeet Singh. This will be followed by a live Q&A session. So I would like to request all our attendees to post their questions in the Q&A tab at the bottom of your screen. During this webinar, I will also share links on how you can connect with Elite Commercial, their IR team, as well as with Sumeet. So keep a lookout for messages in your chat box. With this, I would like to hand it over to Shaldine to take the webinar forward.
Thank you. Good afternoon, everybody. Thanks for spending some time with us this afternoon to listen to our presentation. Hong Ying, could we have the presentation being shared now? Thank you. This is actually what we will go through today will be a presentation of our first half results. I will also, in the meantime, bring about a bit of more information with regards to our tenants and also our portfolio. For those who have not actually been following us closely, it's more for an understanding of who we are and what we do as well. So if I could have page 4, please, Hong Ying. The next page. Okay. So Elite Commercial REIT is the first and only UK-focused Singapore REIT that was listed on the Singapore Stock Exchange last year. So we were quite glad to say that we managed to get ourselves listed before the COVID onset. And what we are is that we actually lease most or almost all our assets to the AA credit rated UK government. So it's very specific investment mandate that we are actually focusing on. We have today 155 office assets across the whole of United Kingdom. This is inclusion of our maiden acquisition, which we did in March this year. All our properties are fully occupied, which means that we don't have any vacancy in our portfolio. And we have always been able to collect our rental in full and on time from the government. Our portfolio stands at £515.3 million, and they are all led to the government through something called the full repairing and insuring leases. In Asia, we commonly term that as a triple net lease, which means the government bears all the costs in terms of maintaining the property. And even in our cases, when it says full repairing, is that if there is any works that needs to be done on the property, any capex work on it, the government will be bearing them as well. Majority of our assets are sitting on freehold land. We have only got a couple, 3% of our total portfolio that is on very long leasehold. So which means that it's close to 100 or above 100 years in terms of leasehold years. The WALE today stands at 6.6 years. Next page, please. So this is a map that shows the whole network of our assets across the United Kingdom, so that you can see that it's actually not very much concentrated on any particular location, or it's actually mainly located on the lighter gray shades, which is actually the more densely populated area in the United Kingdom. And majority of our assets are being used by this particular department called Department of Work and Pensions, and they are the largest public service department in the UK, which means that actually our assets are all being used as a social infrastructure to provide the necessity of use by this department to administer its works to its people. Next page, please. So maybe a little bit more on who DWP is. So DWP is actually the largest public service department that administer mainly all the welfares, pensions, child maintenance policy. So that includes also things like the pensions for the older generations, the unemployment benefits to people who are unemployed, and the disabled benefits to people who are disabled. So with the onset of COVID, DWP sees a surge in terms of the claimants on their portfolio. Prior to COVID, there have been around 20 million claimants, but as of today, definitely there's over 22 million claimants reported. The benefits that the government has been distributing as of end of March 2021 was reported at £212.4 billion, and that's increased from £190 billion from the previous financial year. And this is expected to increase further for this coming financial year as well. Well, all the services are being administered through something called the Job Centre Plus, and these are actually the centers where they have the councils and also people who helps the needies to go in and do applications and do verifications on whether they are suitable or they qualify for such a scheme whereby they can actually claim on the government. So the government actually has, with the onset of COVID, pledged to the people that they will increase the number of job coaches on their site by 13,500 people. And that has been completed in March, and it's still continuing to recruit more employees to serve the need, because they need to get job seeker back into the workforce and to support these job seekers in their search of an employment in the country. So throughout all the lockdowns in the UK, the Job Centre Plus locations remain open, and it also has to adhere to all the social distancing measures. So COVID-19 doesn't actually create a scenario whereby there's any force majeure or there's any tenant that's leaving our assets. In actual fact, the assets are used more than before because of the needies that need to actually come in to do more claims. Now, all our leases thus comes in with a built-in rental escalation clauses. Majority of them that is actually those that are led to the government has got this inflation-linked rental uplifts that is stapled to the leases, which means that it's actually compounded via the actual CPI index, but there is a floor and cap to it, so which means that we will get a minimum of 1% uplift per annum compounded, or a maximum of 5% should the CPI goes beyond 5%. So that is being compounded, and the new rental rate will kick in on the 1st of April 2023. So DWP, being the frontline essential workforce for the national recovery, continues to serve their people through all the centers that is also being owned by us as well. And today we are actually the largest landlord to this particular department in the UK. Next page, please. Next. Coming to a little bit of the financial highlights. So those previously what I've mentioned are the backgrounds and our tenants. Now, I think what's important is how we have performed for the first half of this year. Well, I would be very pleased to say that actually Elite Commercial REIT managed to outperform our results against both the IPO projections and also the actual of last year, since we've listed in the first half of the year. We have also been looking at ways to future-proof our financials. So the manager has announced a few of these initiatives that we are currently working on. In addition, in this first half of the year, we have also completed a maiden acquisition, which sees the increase in our asset size and hence reflected in terms of our financials with the rental collections from these new portfolios that we have acquired. And the team is actively working on asset management and trying to ensure that there's more income visibility in our portfolio. So I'll go into a little bit more details on the respective of these items next. Yeah. So on this page, you are able to see in the performance in terms of the financials for us. In terms of the income available for distribution to our unit holders, we have actually reported a 37.1% increase from our IPO forecast. Increase from our IPO forecast. And in terms of our distribution per unit, we see an 8.7% increase from our IPO projection as well. Sorry, it should be projection, not forecast. It's the second year now. I apologize for that. And definitely this is a confirmation of the acquisition that we have done earlier of this year in March. And that's the impact of the new income that came into the portfolio. Next page. And in terms of a summary, this shows the variations and the variance with regards to the actuals and also the first half of 2020. What we could say is that, because last year we have listed on the 6th of February, so there's slight deviations in terms of the whole one half of 2020 results as of last year. However, we have actually shown the performance, actual performance with regards to this. And our DPU, in terms of pence that has been reported for first half of this year, stands at 2.63 pence. Next page. In terms of a balance sheet, I think we have a very healthy balance sheet. The asset size, assets remain stable. Our total assets is reported at £541.5 million, and our net asset value per unit at 62 pence. Next page. This is a summary of our debt maturity profile. So you can see that there are different towers on each of the year. The total debt today stands at £228 million, a gearing ratio at 42.1%. Our borrowing cost is about 1.9%, and the interest coverage ratio at 6.4 times. We have actually hedged about 63% of our interest exposure till date. Can I have the next page, please? So what I've been talking about future-proofing the REIT and ensuring that the financials are being strengthened and certain is that we have recently announced that we are actually going for a technical listing on the International Stock Exchange, TSE. So this is not a listing whereby you actually trade the shares. Basically, all the units that are listed on TSE will be owned by Elite Commercial REIT. So which means that, this is a technical listing rather than the actual share trading listings as we see on SGX. Well, the objective of this is actually to bring down the principal tax rate that is applicable to the REIT. So today, the current corporate tax rates that the REIT is paying is reported at 19%. Now, the UK government has already announced that by 2023, this is going to increase to 25%. So even before that announcement was made, studies has been done by the manager to see how we can actually minimize this tax rates to be in par with other UK REITs as well. So the idea of this technical listing comes about. So with the success listing of it onto the TSE, we will be able to reduce our tax rate to 15%. Hence, we actually future-proofing our tax losses through the increase in corporate tax in future as well. In addition to that, all the latent capital gains that we have actually gotten in our books, and also all the corresponding deferred tax liabilities will be eliminated through this process. So this is expected to be done this quarter itself, and we will be able to get we will be able to get our unit holders to enjoy the benefits once the completion has been done for this particular technical listing. In addition to this TTSE listing, this quarter itself, we have also implemented and established the distribution reinvestment plan, the DRP plan. We have actually heard responses from or comments from our investors that has been brought up to us a couple of times, and we do see that there are people who are keen to reinvest the dividends back into the REIT. Hence, we have actually put up this option for investors. So now unit holders could elect to receive the dividends in the form of units as well, in addition to the original choice, which is just to receive it in cash. So next page. I think this is basically a short summary of all the dates of this dividend DRP plan. Well, I guess the key thing that people will be more interested will be when is the dividend being paid out? Well, it's on the 24th of September 2021 this year. That is the payment date for our first half dividend payment. Next page. So much on the financials. Let me come to this portfolio and asset management side of the REIT. Well, as I have said earlier, 100% of our portfolio is being occupied, so we don't have any vacancy rate. We have a very long WALE compared to a lot of other commercial REITs in the market in Singapore, so it stands at 6.6 years. One thing which we have been consistently able to report, and we are very glad to say that this actually justify the proposition that we have actually put forth at IPO, is the collection. We have been able to say that within 7 days of the due date, every quarter, we can say that we have received the advance rent from the government. So, which means that the government always pay their rent in full and on time. And that is the resilience of this REIT. And that's the reason why we have been able to pay our distribution that we have promised to our investors at IPO. Now, for this first half of the year, we do have 2 lease events that comes up in our portfolio, and they have been addressed respectively. One is actually a property in Stevenage. So the tenant has confirmed that this break option will not be exercised, and hence the lease is now confirmed to run all the way to 2028, 31st of March. This provides a further rental confirmation on this property, and hence we would expect that they will have some impact on the valuation of the property when it comes to their end values. The second property that we have got a lease event is a small property in Edmunds. So this property in Edmunds, the government decides, basically DWP decides to exercise the break option in 2023. So basically, what we have done is that we have actually evaluated this particular property to see what are the other usage and what can we do better to enhance the value of it. And at the same time, we have also received a buy offer from a reputable buyer in Edmunds that is willing to pay more than 21% above the valuation to us for this particular asset. So the team is currently undergoing all the due diligence on the offer, and we will be coming back to make our announcements once everything is finalized. So I guess in this sense, this particular property has provided us with the confirmation that our assets actually has got more potential than being used as just a commercial office itself. Because in the UK, commercial office are qualified, that are under certain criteria, are qualified to be converted into other usage for residential. And that is one of the reasons why the valuations of different properties are slightly different as well. So this is one particular property that has got a lease event this quarter, and it has been addressed. Next page, please. This is the lease profile of the portfolio. I would say that basically you will see that there is a 23 break options period, but all the leases are actually signed on a 10-year lease. Hence, it's actually expiring in 2028. So as long as the government does not exercise the break option on their side, all the lease will automatically be run all the way to the end of the lease term. Our CIO, Jonathan, has just been relocated back to the UK. So he's currently now in London at the same time zone with the tenant, and has been working very closely with the tenant to ensure that our asset management plan has been taken on board, and we have more certainty in terms of and visibility in terms of our income in future years. Next page. I'm not going to bog you down with all these. This is just a summary of our maiden acquisition. So what we can say is that with this acquisition, we have also diversified our tenant base and also increased more concentration into London area itself as well. And with this acquisition, we have actually included one of the largest shareholder onto the register, being a European institutional investor known as Partner Reinsurance. Next page. This shows the breakdown of the different tenants that we have. DWP constitute to almost 93%, but we have slowly adding in other departments such as the Ministry of Defence, National Records of Scotland, Courts and Tribunal Services, environmental agencies, and this is going to continue because that's where we are heading for in terms of our diversification in our tenant base. And in terms of the breakdown of locations, we would see that more than 30% is now of our valuations of portfolio is concentrated in the London and the Southeast region as well. Next page. So the REIT has been performing very resiliently. We have been outperforming the S-REITs index throughout the whole period since we have listed. As with any other REITs, there was some impact during the COVID period, but it has rebounded and recovered very quickly. We are continuing to engage our investors, such as this particular event that we are doing now. We are also reaching out to more research house for coverage of the REITs as well, to get more investors to understand us and to understand the portfolio. Next page. So I'm coming to the end of this presentation. In terms of market outlook, I would say that UK is recovering. It has already started to slowly open up. The economy is expected to grow at 7.25% in terms of GDP growth for this year. However, the unemployment is still standing high. The unemployment is expected to peak by 3Q this year because the furlough scheme is expected to end on the 30th of September this year. Well, in terms of the REIT side, we would say that we will continue to provide a very stable income and also distribution to our unit holders, as we are not very impacted by the COVID-19 situation, nor are we impacted by the Brexit situation. We are continuing to look at acquiring and growing the REIT, both from the open market, third-party sources, and also from the ROFR pipelines that we get from our sponsors. So with this, I'll end the presentation and we'll open the floor to questions and answers as well.
Thank you, Shaldine, for the detailed presentation, and congratulations to you and your team for a good set of first half numbers. Yeah? Pretty strong numbers coming out. So what I noticed is most of the numbers are driven a lot by a recent acquisition, and natural questions that comes to my mind looking at your kind of portfolio the way it is, it's mostly rented out to the government. These properties are somewhere between, I would say, they're not traditional office assets, but they're still office assets used by the government. In your view, how much of a pipeline do you have of these kind of assets in the UK? Just to give us an idea, because these are not traditional assets that everyone kind of knows and talks about.
Yeah, I think maybe a bit of an understanding on the UK market here. The government assets in the UK are not owned by the government. The government actually has already went asset light more than 20 years ago. So the assets are actually mainly held by investors. So it's in the third party hands. And there is a very attractive or active trading happening in the UK with regards to this kind of long leases properties. So on our side, basically we have been looking at the portfolio in the market. We have actually looked at currently definitely more than 200 million pounds that we are looking at. But of course, everything has to become with the right yield. It has to be accretive. So of course, we have to weigh the difference sort of like pricing as well. And in terms of ROFO pipelines, we also have a healthy pipeline coming from the sponsors. While we know that for the REIT to acquire, there is also a long process of fundraising that's required. The sponsors are willing to step in, and when they see a portfolio that is suitable, they can actually buy and hold it for us. When we are ready, we'll make the offer to buy the assets from them as well. So there is about more than 100 million that's currently being held under the ROFO pipelines. So I would say that it's a very healthy portfolio that we are looking at. So it's a matter of time and also pricing that then when we can actually come back to the market to say that we are going for a second acquisitions coming up.
Okay. And all these assets will be similar to your current portfolio. They all are rented to some government department.
Yes.
And then
Yes, they are. Yes.
Sorry, Shaldine, did you want to take one of these questions? I didn't know. Can you hear me clearly?
I could, because I couldn't see that you have come in. As John is now located in the UK, we do have some technical issues here. No problem, John. Why don't you take the acquisitions question here?
No, I think you've answered it pretty fully already. I mean, just a couple of extra points. In terms of the UK government as a tenant, actually the UK government is the largest occupier of real estate in the UK. And as Shaldine mentioned, as an organisation, they went asset light. So the market has a very large number of kind of investment or kind of opportunities for us as a REIT and other investors to look at. There are multiple departments of the UK government. Obviously, we are the largest landlord to the Department for Work and Pensions. That was the largest tenant in our initial portfolio and in the second acquisition. But beyond Ministry of Defence, HMRC, which is the tax collection agency, there are also departments such as the Environment Agency, Border Force, and very many others that act as tenants in office buildings all across the UK. So that gives us an opportunity to sort of undertake sort of careful asset selection. And really what we're looking for is buildings which produce the right kind of yield profile for the REIT so that we can make accretive acquisitions. But where we think that the buildings are used as a government facility, and therefore that the government is likely to remain in occupation for a long period of time. That's really what we're looking for as we make acquisitions. And yeah, as Shaldine has mentioned, there are about, we're actively looking at about 250 million pounds worth of assets at the moment to determine whether they are suitable for us to go and acquire, subject to the right market conditions. And then again, the sponsor has a further pipeline of in excess of 100 million pounds worth of assets. Yeah, and these are all office buildings let to the UK government in good locations, be it in London and the southeast or in good regional cities.
Thanks, Jonathan, for that. That helps a lot. So is it fair to say that at least for the next 3 to 5 years, your portfolio is pretty much going to remain similar, where you'll have most of your assets tenanted by the government? I think
for so long, when we set up this investment strategy, which was really focused on providing investors with a very stable income return as well as capital growth, but it was very a defensive investment strategy. So it was built to be able to cope with the economic effect of an economic shock such as Brexit. Brexit seems like a kind of long time ago as an idea, but when we were doing the IPO, that's what most investors were looking at. And really, there was no other vehicle in the market that really just was able to provide investors with this highly defensive income. But obviously, since COVID-19, the economic shock to the UK and global economy has been far greater than than the one sort of envisaged by Brexit. So, that investment strategy has helped this REIT perform extremely well during its first 18 months of operations. And because we occupy a niche, and we're beginning to better understand, just through our existing relationships with various government occupiers, exactly what, as an organization, they are looking for in terms of their property portfolio that they want to occupy as tenant. We're getting better at our work. So I think for the time being, and this is really in response to discussions that we've had with investors, that we will continue to look at office buildings let to the UK government, focus just on the UK for the time being, because that's what has enabled us to perform really strongly so far.
Yeah.
Sure. Yeah, I mean, that makes sense now that you put it in that light, that you built a portfolio for Brexit, but you ended up flying through COVID. So you
Yes.
had occupancy, rental paid upfront. I mean, that's you can't ask for better than that during those times. So I actually have a couple of questions, and I also see that people who've joined the webinar have similar questions. So I'll kind of, I think, keep them in as well. One is, obviously you seem to have quite a good pipeline of acquisition. So the natural question obviously comes, what are you thinking about funding? What kind of gearing levels are you comfortable with? So if you could add a little bit of color on that, that'll help.
Yeah, I can take this. I also spotted the questions on the Q&A. I think generally we do receive these questions that the gearing is a little bit on the high side. So I just want to frame this for investors as well. So MAS actually provided a guideline in April 2020, where as long as your interest coverage ratio is more than 2.5 times, the regulatory limit is 50%. So in other words, the framework has changed somewhat. 45% is no longer the base case. Now the framework allows for 50%. So that said, the manager is not going to go gangbusters and try to raise the gearing to that level. We are still very comfortable, our long-term gearing ratio to be between less than 40%. It's just that for this particular situation, we did explain to investors that as part of our maiden acquisition, the managers actually came up with two options of funding the acquisition. One via a mix of equity and debt, and one via Plan B, which is just to use all our internal resources and debt. So at the point of time when making the maiden acquisition, the manager viewed that the market wasn't that conducive or elegant for funding the acquisition elegantly. So we decided to take the short-term blip in terms of the higher gearing ratio, with the intent to address that shortly thereafter. So that is so going forward, certainly without a shadow of doubt, to grow, there will definitely need to be a mixture of EFR and debt funding to fund new acquisitions. So that is something that the manager will be seeing doing in tandem as we look to acquire future acquisitions. Yeah.
Okay. And thanks for that, Joel. Now, one question I've always had whenever I looked at the structure at the time of the IPO as well, is most of the traditional REIT in Singapore, especially, which are mostly seated by the government entities, Keppel, Mapletree, you have Ascendus. These are like almost household names in Singapore, right? You, for instance, have 3 sponsors, not one, not 2, but 3. So I always wonder, like, what does everyone bring on the table, and how does that help you kind of grow as a REIT as you go along?
Right. I think it gives some, got to give it a bit of a background. So when we first started looking at this portfolio, we were setting it up like a private fund. So what happened back in 2018 was that the founders are basically of Elite Commercial REIT sponsor, which is Elite Partners Holdings. So they were actually fund managers. It was set up by the ex-guys from previously Viva Industrial Trust. So Victor Song actually founded EPH, this group. And together with it, what came along was the Holy Group. So Holy was also the founder or basically the sponsor for Viva. So if you could recall, during that time, Viva was in the process of merging with ESR and hence forming the bigger ESR REIT. And so the sponsor and also the founder was deciding to see, what is there in the market outside of Singapore that could be of interest as a REIT for the Singapore space. So we chanced upon this particular portfolio in the UK that was being put on sale, and it has got a new fresh 10-year leases coming from the government. So it ticks a lot of boxes of what we are looking at, and something that we don't have in Singapore yet for our investors here. So that was how, if you look at 3 sponsors, 2 of them are actually in the whole group. They are actually also owning each other. Wholly also owns EPC in a way. So basically, we have one group of guys who has founded this. And when we were doing the private fund, we were trying to introduce this to other investors. And we met up with this group called Sunway RE Capital. So it's actually a wholly owned subsidiary owned by the Malaysia Sunway Group. And they have always been trying to get into recurring business apart from their own traditional development business. So in terms of visions, it come hand in hand. So the decision was then for the 3 of them to come along and form together the sponsor group for this REIT itself. At the same time, they were also the original sets of investors that have invested in a big portion of the portfolio that we see is possible to bring to the stock exchange, because the transaction in UK moves very fast. No one is going to wait for you to put this up into the portfolio and get it listed before you could acquire it. So we have to acquire it and then get it done. So how they actually then contribute to us now is that although they are not like, the government entities who has got a lot of pipelines, they, like what I said earlier, they have been helping us to build the rover pipelines. So while we are trying to build up the REIT and also trying to grow it, we can't keep going to the market and say that I want to raise a lot of funds. Transactions happens within a few days. So what they are doing is that they are helping us to look at what is the potential in the market. Assets that are being able to be acquired now can be acquired under a private fund, and then we will then be able to buy it off them. So if you look at the prices that we are acquiring, it's very decent. It's not the kind of developer cost that we are talking about. So in a way, they are trying to help the REIT grows this portfolio in a timely manner, I would say.
Okay. That helps, at least with my understanding of the whole structure, a lot. Now, there are a couple of questions coming in about the lease expiry, and I also kind of had a question. Before I kind of pick on those questions, one thing that stands out about your REIT is that you're kind of inflation protected, aren't you? Because you have that CPI window of 1%. And in today's, a couple of months back, the news was all about inflation going out and rates going up. So if that were to happen, say next 3-4 years down the line, you will be kind of well protected because of your structure, right? But your structure, what I want to clarify is your structure says the rental reset happens in 2023. So is that for the entire portfolio, like 100% of the portfolio resets in 2023? Or is it like a part of the portfolio, big chunk of the portfolio? And I think that kind of answers one of the questions about 63% of the asset having a break option as well, I think.
Yeah, and I can take this one. So, it's pretty much sort of 94% of the portfolio has a index-linked lease in it. And I think Shaldine briefly explained the way that structure works, which is that the rent rates were set originally in 2018, and then there's a rent review that happens in 2023. So after the 5th year, the rent will increase in line with CPI. So CPI increases by 1% or I think it was close to 1.5% in between 2018 and 2019, and then another 1.5% between 2019 and 2020. And those increases are compounded every year all the way up until 2023. So what is the case is that we are until 2023 we are hedged against inflation rises, because our rents will, for the majority of our portfolio, the rents are going to increase in line with inflation. Beyond 2023, well, we're just then relying on inflation being the reason that rents generally increase, because we don't get the same increase in 2028, which is when the leases would expire. So we're fully hedged until 2023, and then after that we're only hedged as any other property company would be hedged that doesn't have inflation-linked leases in its portfolio. So in terms of the break clause, there are less properties in the portfolio that have a tenant-only lease break in 2023. So there's about 64% of the portfolio that has a tenant-only lease break in 2023. There have been a few assets that, for one reason or another, the tenant had to notify the landlord either 2 or 3 years in advance of that March 2023 date, and they've included a property in Sunderland, a property in Bristol, a property in Stevenage, all of which had the lease break notices removed or extended out. So the only asset where there has been a lease break which has been exercised by the tenant in advance is this property in Epsom, which Shaldine has mentioned. In fact, we continue to try and work and understand from the tenant why they've exercised that break clause, because it's not 100% clear yet, and we don't think they've yet made up their mind. But in the meantime, we have received this offer to sell the building at significantly above valuation, and in any case, the rent is, and this is to answer a question that came in, the rent will continue all the way through until March 2023. So actually, we have. I suppose the final point I'd like to make on the remaining lease break notices that the tenant has in 2023. We're now, and part of our ongoing tenant relationship management is to maintain a regular dialogue with the tenant about this and other matters. So, we'd hope to be able to come back to investors, within the next 6 months, just to provide an update on that issue. But it's something that we're working hard with the tenant to come to a resolution on. I think the reason that we have stated in the past that it's so important how the tenant uses these buildings. So the tenant has, what we've seen is almost a doubling in the level of activity in each of these assets since the onset of COVID-19. We've seen the government employ, another 13,500 people to work in this for the Department for Work and Pensions across its portfolio. So our sense is that the likelihood of the tenant exercising a significant number of break clauses is quite low. So I've answered several questions there, so I hope that's all clear. But do let me know if you've got any points you'd like me to provide a bit more detail on.
Yeah, I just had one question on the back of what you just told us, Jonathan. Do you, by any chance, on the top of your head, have any recall of how long the government has actually been in some of these assets? Because I know you've only owned them for a couple of years, but if they've been around for 20, 30 years in the same asset, then the lease clause is like a technical thing, right? Almost.
I mean, the government have occupied, from what we know, the government have occupied these buildings for at least 23 years now, or since they were constructed. So the government went asset light in about 1998, and by going asset light is essentially put a whole load of its freehold estate into an SPV and took a 20-year PFI contracted lease back from that SPV. And it's only when that contract came to an end in 2018 that actually it's the first time these assets were available to acquire on the open market, and that's what Elite did. It bought these properties at that time. So what we know is that the majority of these assets have always been occupied by a government tenant. So in some cases that's 30, 40 years, and in other cases because the properties were only constructed in 10 to 15 years ago since they were constructed. So on the whole, the government have been occupying these buildings for a very long time.
Okay.
Maybe one point just to add, sorry, Sumeet, just one point to add here is that, when the government decides on which are the locations that they want the job center plus to be in, they have certain criteria. So these properties, when they had a sort of like evaluation done in 2018, they have actually this sort of like evaluated in the whole region, basically where are it's located, because they committed to the people that they should be able to access to one job center plus within 25 minutes of the transportation time. So there are certain criteria that they are selected. It's not as if like, you can just move into another building easily. There has to have certain credentials in that particular location for it to be selected.
Okay, thanks, Shaldine. I think I just about have time to squeeze in maybe just one last question. There's someone asking about, do you do any hedging on a distribution? I think you pay out in pounds, right? So you don't really hedge it, do you?
So I think for the benefits of investors, right? So the whole vehicle has been structured in such a way with minimum hedging risk. So all our functional and reporting currencies are in pounds. Our distributions are declared in pounds. So, and our trading itself is in pounds. So we structure in such a way that our asset liabilities are pretty much, there's no mismatch. So there's a very little need for any FX hedging. On the interest rate side, we have hedged about 63% of our interest rate exposure by fixing 63% of whatever interest rate that we have. So I think essentially this vehicle is structured in such a way to create a peace of mind for investors. The FX is there's no FX, there's not much FX mismatch, and the interest rate, we have hedged majority of the interest rate exposure. Yeah.
Thanks, Joel. I think we're kind of running low on time, so I'll have to hand it back to Vidhi. I think you managed to answer most of the questions.
Yeah.
Thank you, Sumeet. Thank you for some very interesting questions. We had some really good questions coming in from our attendees as well. So thank you so much. I would also like to thank Shaldine, Jonathan, Joel for a very detailed insight into Elite Commercial REIT and the whole REIT sector in UK. I would also like to thank the attendees who were able to join us live today. With this, we will wrap up this week's corporate webinar, and we will see you again soon. Thank you and have a great week ahead.
Thank you.
Thank you.
Thank you.
Thank you, everybody.